Digital Dopamine podcast episode number 9. We are getting up there to the double digits. It's a nice little milestone that I'll reach, but yeah, number 9 for now. We'll do a hack with me next, and then we'll get the good old 10 in there. But on today's episode, we're just going to go back to tokenization and the idea of tokenizing assets, mainly because of the newer deal with the DTCC and Stellar. Now, I had mentioned and talked about tokenization a while ago when we were learning that a lot of private equity was looking to start to tokenize assets, and then private equity themselves were meddling within 401ks, and with the 401ks, they're thinking about tokenizing that, and that is our funds getting tokenized and messed with, or I wouldn't say messed with, but adjusted without our consent and or our knowledge in general. So fast forward to today's day, and we see this deal between DTCC and Stellar. It's a bit of a conflicting situation for me because I do really love Stellar. They are a fantastic organization, but the DTCC is literally the main pipeline for the U.S. security settlements. If you're selling anything, or if you're trading anything, I should say, on any of these markets in America, E-Trade, Robinhood, Fidelity, any American, or I should say most American trading platforms go through the DTCC when it comes to settlements. Now, I wanted to touch on the deal itself and go into a little history of both the DTCC and Stellar, but I guess I want to get into a little bit of my opinion of this whole deal. And I'm biased with this deal purely because I know how Stellar's blockchain consensus was built and created. I know that this is going to be a decent, if not great deal. And again, my bias stems from knowing Stellar's past and how far they've come since their inception in 2014. So they set out to be one of the few blockchains that wanted to bridge the gap between traditional finance and exchange by making products that allow people who had family in underdeveloped nations to supply their family members with funds almost instantly with little to no fees, as well as no major friction when it came to the exchange rate. So this, of course, sounds amazing on paper, and you think everyone would be on board or behind this adaptation and growth of this type of technology. But of course, here comes the big banks. Or I should say more so, here comes Swift to try to build their own product similar to what Stellar was offering. So the Society for Worldwide Interbank Financial Telecom, which is what Swift stands for, is definitely not a fan of what Stellar could have been as a replacement, which is why Swift decided to build their own railway for quicker transactions and quicker settlements with lower fees. They're also building on blockchain as well, because that's really the only way that's possible. The deal that the DTCC did with Stellar isn't the first and probably won't be the last deal it has done with layer 1 and layer 2 blockchains. Now, some might ask, what are layer 1 and layer 2 blockchains? So just a quick, definition that I pulled from a Casper article that I will have linked in my article. A layer 1 blockchain is the foundational layer of a blockchain network. This layer includes the main network architecture and protocols responsible for executing transactions, validating data, and maintaining consensus. Bitcoin and Ethereum are classic examples of layer 1 blockchains, along with the likes of Ripple and Stellar. They form a base upon which all other processes and applications operate. The term layer 1 refers to their role as the primary underlying infrastructure that supports the entire blockchain ecosystem. So, example why Stellar is a layer 1 blockchain is that companies are building on top of Stellar to create other products, and those products are considered layer 2. For instance, Circle, which produces the stablecoin USDC, they built USDC on top of the Stellar network. USDC itself is a layer 2 blockchain network. Now, to get into the actual definition of what layer 2 is, layer 2 solutions are built on top of layer 1 blockchains to address their scalability limitations or to address other feature limitations that aren't as easily solved or resolved just by using the layer 1. These secondary frameworks enable transactions to be processed off-chain before being settled on the main network, significantly enhancing transaction speeds and reducing costs. Layer 2 is not a separate blockchain, but rather an extension of the existing Layer 1 network, designed to improve its efficiency without compromising security. So technologies like the Lightning Network for Bitcoin and rollups for Ethereum exemplify Layer 2 solutions. Now, before Stellar, DTCC partnered with digital assets on the Canton network to tokenize DTC custodied U.S. Treasury securities, with the DTCC serving as co-chair of the Canton Foundation alongside Euroclear. And Euroclear is pretty much the European version of the DTCC. They handle most of the security clearings over there in Europe. That MVP targeted the first half of 2026, and in July 2025, a broad industry group already completed live 24/7 trades with on-chain intraday and after-hours financing using tokenized treasuries on Canton. Separately, DTCC named Chainlink as the data orchestration layer for its forthcoming tokenization or for its forthcoming tokenized collateral platform, another distinct partnership worth mentioning. The DTCC also has a concrete platform timeline independent of any single chain. So limited production trades begin in July 2026, so that's coming up, with a full platform launch in October for these tokenized assets, which would cover the Russell 1000 stocks, ETFs, and Treasuries under an SEC no action letter obtained in December of 2025. So the DTCC is not new to this at all. They're true to this. But they aren't the only ones in the race to tokenize assets. You have ICE, which is the Intercontinental Exchange, not the useless, corrupt Immigration and Customs Enforcement Agency. The International Exchange is the owner of the NYSE, so that's the New York Stock Exchange, and they are backing tokenized security initiatives tied to OKX, which is a DeFi blockchain platform. Then you have the NASDAQ developing infrastructure for blockchain-based stocks with Kraken parent company Payward. There are plenty more examples of big players making moves, but the problem is that no one knows about it. I can go up to almost any of my friends or family, intelligent folks, and 90% of them would not know that these institutions or depositories are trying to tokenize assets, let alone know what the tokenization of assets even is. So we need more education around the subject, and hopefully folks can start to pay attention to who's making deals and who's around these major changes so that you can plan accordingly to either shuffle your assets around, learn more about blockchain and crypto to maybe invest in blockchain companies doing real and proven work to improve our financial system in real ways. Those companies are legit, even though they have crypto tied to their reputation. Or lastly, just so that you understand tokenized assets as a whole, so you're just not surprised when you see these changes happen and you're not scrambling to try to figure out what it is and why it's happening and what you can do. If you're informed, that just helps you stay prepared for any type of future changes or actions that will heavily affect your assets. Now, with these changes, it doesn't mean we don't still have time to learn a bit about them and about the companies behind them. So I'm going to focus on the two main players of this article, which is Stellar and DTCC. Stellar was launched in 2024 by Jed McCaleb and Joyce Kim. McCaleb was a notable figure in early crypto history. He had previously created the Mt. Gox Bitcoin exchange and co-founded Ripple before falling out with the Ripple's other co-founders, and that led him to start a new project, which was Stellar. Stellar's code base initially forked from Ripple's protocol, but the team rewrote the consensus mechanism, resulting in the Stellar Consensus Protocol, a federated Byzantine agreement system designed to be more open and decentralized than Ripple's approach. Unlike many crypto projects with a profit-driven corporate structure, Stellar is steered by the Stellar Development Foundation, which is a nonprofit. You can probably see why I actually respect this blockchain company so much and why I strongly believe that they deserve a role in our financial system's future. But from the outset, its stated mission was explicitly aimed at financial inclusion and cross-border payments, connecting people, payment systems, and banks, and serving populations underserved by traditional banking. Between its inception in 2014 and 2018, Stellar was making major moves, inking partnerships, and implementing their protocol overhaul, which was the change from Ripple's core protocol to their own Stellar's consensus protocol. The amount of real-world business deals made were a clear sign to me that this company would be insanely successful, and they 100% were. Now, I wasn't invested in crypto at all during this time when they first got the ball rolling, between 2014 and 2018. I was still very new to the space, and I was young and broke. So investing was the last thing on my mind to do with my extra bit of cash when I had it. I did educate myself, but I just spent my extra cash on other things, being young and dumb. Now, from that timeline of 2014 to 2018, Stellar exploded over 7,000%. I can't tell y'all how salty I am that I didn't throw my extra $20 here, extra $20 there, as I was growing and trying to pay off my debt and all that stuff and surviving. But I had $20. I spent $20 on other stuff that I didn't need. I could have spent $20 on investing properly, and who knows where I would have been by now. I digress. That's not an important part here. But even today, as of 6/13/2026, Stellar is up 5,900% since its inception. So the era of legit blockchain companies going to the moon like this is long gone. But that's not to say that this is no longer a good company to invest in. I'm not telling anybody to do anything in terms of investing. Everybody should do their own due diligence and research and consult with whoever you think you need to consult to professionally before making any investments. This is just an opinion from a random dude. And I still think that Stellar is a fantastic company to invest in if you are intrigued and interested in the work that they're doing. Now, I'm a believer in investing in companies that you have faith and you truly think is doing good work for humanity, or at least good work for the consumers, providing a good product at a reasonable price, or like what Stellar is doing, providing great products that enable nations and societies that aren't as technologically advanced to start to access some of these systems that make us the modern, civilization. With that said, I think that even now is a better time to invest in a company like Stellar because they're so tenured and they have been in the game for so long and they have so many real world deals and partnerships going on. It makes the most sense for when we do transition to this tokenized and more digital world than we already are, that Stellar is going to be one of the big players in that whole ecosystem. Speaking of its partnerships, it's intertwined with the likes of IBM to launch a WorldWire, which was a cross-border payments network built on Stellar rails. They're involved in a number of banks experimenting with stablecoin-based settlements, and they are involved in the expansion of anchors, which are regulated on and off ramps across Latin America, Africa, and Southeast Asia, where remittance use case gained the most traction and it's most needed. So even more with the stablecoin situation, Stellar has become one of the better networks for stablecoin issuance due to its low transaction fees and quick settlement times. USDC, which was the example I mentioned earlier, which is a stablecoin owned by Circle, is a great example for stablecoins being issued on Stellar's network, given the fact that they are a pretty big public company now being traded on the normal stock exchange. And again, that's just some of the partnerships and use cases it had before 2024. Now in 2024, there was another big release, and this release was the launch of Soroban. Now, Soroban was Stellar's version of smart contracts. So that's their smart contract platform. And in a way, it's similar to how Ethereum has their smart contracts. So that's about the only thing that's similar between Stellar and Ethereum smart contract ecosystem is that they are smart contracts. That's about it. Ethereum smart contracts run on the Ethereum virtual machine with contracts built primarily in Solidity, which is a coding language specifically for smart contracts on Ethereum. Now, Stellar's Soroban takes a different approach. It uses WebAssembly, and WebAssembly is a runtime that has a broader range of support for different languages, with Rust being the primary one. Rust's appeal here is partly about performance and memory safety guarantees that reduce certain classes and bugs common in smart contract exploits. So Soroban's advantage is that it was designed from scratch to avoid the cost and scalability problems Ethereum is still, to this day, trying to manage, while inheriting Stellar's existing strengths in payments, remittance, and institutional tokenization credibility via the DTCC deal. So again, Stellar is just a fantastic company and organization. I highly recommend people look into them. They've done a lot of great work in the US, but they've done even greater work in other nations and countries, like countries in Africa, countries in Latin America. And it is something that people should do a little bit of research on to understand what they got going on. It's just a few more notes and I would say, milestones or accolades that I want to note on Stellar. Stellar ranks 4th among blockchain networks by tokenized real-world asset value, which is roughly 1.4 billion in RWAs and about 5.24% market share of that segment, which is not a small number. Having that much in real-world assets is a testament to how institutions are viewing Stellar and how legit they are that they trust Stellar with that much money in terms of real-world assets. Its core technical advantage, I mentioned a couple earlier, which were low transaction costs, fast settlements, and a consensus mechanism that is not reliant on energy-intensive mining, which is a huge advantage for everybody that's concerned about global warming. I am as well, and the damage to our environment that a lot of these mining operations cause. People are worried about AI. Blockchain was in this game of running up data centers well before AI. So building out these new low-cost mechanisms so that it's not depending on mining saves a lot of money, of energy-wise, saves us the damage to the environment, and also saves a lot of money and time for the consumer because the transaction costs are much lower and the settlements are so much quicker. And that's why Stellar is a popular choice for remittance, corridors, stablecoin issuance, and now institutionalized tokenization, or their pilot programs, I should say. Last little note is that the network operates as a public permissionless blockchain with built-in compliance tooling such as configurable asset controls, and that makes it attractive to regulated entities and a middle ground between fully open chains like Ethereum and fully permissioned ones like Canton. Now let's get into the DTCC, which is the Depository Trust and Clearing Corporation. Now, the DTCC was formed in 1999 through the merger of two organizations, the Depository Trust Company, DTC, which was founded in 1973, and the National Security Clearing Corporation, NSCC, founded in 1976. Both were created in response to the paperwork crisis of the late 1960s and early 1970s, when Wall Street's back offices were overwhelmed by the physical volume of paper and stock certifications being exchanged. And this crisis apparently was serious enough that the New York Stock Exchange shortened trading days and closed entirely on Wednesdays to let firms catch up. DTC's solution was to immobilize physical securities in central vaults and instead record ownership electronically, effectively the predecessor concept of what tokenization is decades before blockchains existed. And NSCC, meanwhile, handled the clearing and netting of trades. The 1999 merger combined custody, clearing, and settlement under one organizational umbrella, and the DTCC has since become the central piece of plumbing underlying the U.S. securities market. The fact that I'm just learning about the DTCC now in today's day, and I feel like I haven't heard anybody really talk about the DTCC in the videos or that I watch on YouTube or any of the other journalists that are involved heavily within crypto and the blockchain space and finance space, is mind-boggling to me, because being the underlying plumbing for the U.S. securities market, to me, makes it seem like they should be front and center with a lot of articles, a lot of news when they're doing these type of deals and making these types of waves. And it goes to show what I mentioned on one of a quick clip that I had created, that they're settling a lot of money. And I'm going to get into the exact amounts that I have here, but it's just crazy how not a lot of people are really talking about them. Now, all stock trades, from Fidelity, E-Trade, Robinhood, that's being cleared by the DTCC. Custodial banks and depository institutions, cleared via the DTCC. You need all the clearinghouses, and you need a central counterparty for various asset classes. Yep, the DTCC's domain as well. They have a hand in so much of the total money exchange in the US, it's insane. Now, the DTCC is structured as a user-owned cooperative. Its member banks and broker-dealers are also its owners and primary clients, which has historically made it deeply embedded in the traditional financial industry rather than a standalone for-profit competitor to its members. And I can already see how the water gets very muddy in this instance, because it's hard to trust traditional legacy banking systems, because they have time and time again screwed over the lower class by gatekeeping access to funds, loans, and just accounts. And that's just the lower class. I want to talk to y'all about what banks have done to black folk and how shitty they are for international folks as well. But the DTCC's subsidiaries collectively process an enormous share of U.S. security activity. Figures cited included roughly 20 trillion in U.S. security trades processed daily. That's 20 trillion daily, and subsidiaries handled 4.7 quadrillion in total security transactions in 2025. 4.7 quadrillion in total securities transactions in 2025. That's insane. The DTC, its central depository subsidiary, custodies securities valued at over $114 trillion, spanning issuers from more than 150 countries. And the more I dug into this, the more I was like, how have I never heard about the Depository Trust Clearing Corporation? It's crazy, man. It's kind of mind-boggling. But the DTCC's tokenization strategy is explicitly multi-chain. With the Canton network, they're using them for permission treasury tokenization, and that's about it from what I'm reading here. Now with Stellar, they're using Stellar for public chain access, and then they're using Chainlink as a data orchestration layer for forthcoming for forthcoming tokenized collateral platforms. Now, the DTCC has stated it does not intend to pick a single winning chain, but to build interoperability across many. So you can imagine that there will be a handful of winners in the blockchain space, so long as they ink partnerships and deals with institutions of the same caliber as the DTCC. The October 2026 commercial launch of these tokenized assets, if it proceeds on schedule, would represent the first time a major slice of the U.S. equity and treasury market, again, the Russell 1000 stocks, ETFs, and treasury bills, bonds, and notes. It'll be the first time that that's all available in tokenized form through the official custodial infrastructure of the U.S. markets. This will be huge in terms of a step towards the shift for tokenization of assets, amongst other things like the tokenization of deeds, the tokenization of contracts, even the tokenization of family wills. I don't see anything that is related to some sort of written agreement not being tokenized as well, because of permissionless agreements between both parties. Now, I'm just going to go over a handful of milestones for the DTCC that I pulled off of their sites and their blogs and newsletters. So in 1973, the DTC was founded to dematerialize physical stock certificates, like we mentioned earlier. Same with the NSCC, founded to centralize trade clearing and netting. 1999, both the DTC and NSCC merged to form the DTCC. Now, in the 2000s, the DTCC expanded internationally and into derivative clearings via subsidiaries. Example, the Fixed Income Clearing Corporation, it was one of their subsidiaries that they expanded with internationally. In the mid-2010s and onward, the DTCC begins exploring distributed ledger technology for post-trade processes, including early pilots for credit default swaps processing on blockchain. That's from mid-2010s. They've been working on this for a long time. And then when you have the idea of these banks trying to fight blockchain and fight crypto so hard in the early days, just for them to be doing it behind the scenes through other arms of connected, companies or organizations like the DTCC, is a smack in the face to the people, obviously, but it shows how good they are at hiding what their true intentions are and what they're putting their money towards. Because if people knew the DTCC was aiming for this in the mid-2010s, I guarantee news outlets and more organizations and people in general would have been investing in blockchain and crypto well before post-2020 and post-COVID. Because I feel like post-COVID is when more people started to really get into crypto. Now, let's fast forward to December 2025. The DTCC receives a no action letter from the SEC permitting its subsidiary, DTC, to offer tokenization services for the Russell 1000 ETFs and U.S. Treasuries on pre-approved blockchains for a 3-year period. Simultaneously, the DTCC announces a partnership with Digital Assets, which is a company named Digital Asset, to tokenize treasuries on the Canton network, with the DTCC also becoming a co-chair of the Canton Foundation alongside Euroclear, like I mentioned earlier. May 4th, 2026, the DTCC convenes an industry working group of 50 plus firms, including Bank of America, Citibank, Goldman Sachs, JP Morgan, Charles Schwab, Circle, Anchorage Digital, and others, to shape its tokenization rollout with limited production trades targeted for July 2026 and a full launch in October of 2026. And May 6, 2026, the DTCC CEO Frank La Sala discusses plans to work with multiple high-performance Layer 1 blockchains to bring corporate actions, dividends, tender offers on-chain. And lastly, which is the big deal we're talking about here, on May 27th, 2026, the DTCC and Stellar Development Foundation announced the Stellar partnership targeting first half of 2027 for live development, which will be DTCC's first connection to a public rather than permissioned blockchain. And with all these big moves and milestones, you think, again, that more people would know about the DTCC or at least speak about them. Granted, there are folks out there that do speak about it, but I feel like what the DTCC is involved in and how deeply is embedded in the US markets, the news that comes out regarding the DTCC or related to the DTCC should be echoed and echoed loudly. The US runs on the stock market as a whole. Our worth is the stock market. That's where most of our value is nowadays, unfortunately. I'm not saying that as a good thing. That's a terrible thing. So there should be way more scrutiny on the deals that they make and the partnerships that they start that have a chance of changing the way assets function and how our assets are allocated. And what the DTCC is trying to do will open the door for 24/7 trading, where settlements are instantly settled and they are able to provide real-time liquidity. But there are problems with that. And the volatility of the crypto market being transferred to the stock market is something that I don't think people are prepared for or even want or could prepare for. It'll be, a lot of people will lose their money and start to gain fear and then sell when they shouldn't be selling, all to turn around the next couple of days to see that stock go back up to where it was or even higher. The volatility will increase rapidly when these markets become 24 hours and trades are 24/7. And even the CEO points out the risks to this issue, saying that scalability of public chains at Wall Street's transaction volumes, liquidity fragmentation across multiple competing chains, and the potential loss of netting efficiencies that DTCC's centralized model currently provides. He was saying that these aren't minor technical footnotes, and the netting efficiency in particular is core to why centralized clearings exist in the first place. So how it translates or how it doesn't translate to a multi-chain tokenized world is one of the more important unresolved questions in this whole transition. And with that, only time will tell how things will pan out with the tokenization of assets. I think that it's both beneficial, but will also have some issues and drawbacks to the tokenization of certain assets. I had to lower that because I was getting blinded. I think there are benefits to the tokenization of assets, but again, I just can't help but to think that because it's not put in front of the public as frequently as it needs to be in terms of discussing what's changing and giving the public an option to vote otherwise or vote in a different direction, to me that makes it seem like this is another sly way of transferring wealth. And while it might not seem that way explicitly on the surface with these deals, what will happen when things become tokenized and 24/7 trades start to become a real thing, the corruption that goes behind that, I think, will increase tenfold, and not by the average man, but by white collar executives and governments that are corrupt. It's inevitable, in my opinion, if that's the case. Again, only time will tell, and I hope that I'm wrong on that front. But thank y'all for joining me on this episode. Hopefully you learned something today. Hopefully you took something away from this whole tokenization situation, and be prepared, y'all. Start to look into this stuff. Get your ducks in a row, because the tokenized asset move is coming. How quickly it will finally arrive seems quicker than we thought, and we will see a test of that come October 2026. So until next time, y'all. Peace.